how does a tech giant lose $309 million dollars in a single quarter, step onto an investor stage, and proudly announce that their business has literally never been more fundamentally profitable? Welcome to the deep dive.
It's quite the hook,
It
Brett.
really is. So, our mission today is decoding this internal script from Block's Q1 2026 investor presentation. And what we're looking at isn't just a company that makes those, sleek little card readers or a simple peer-to-peer payment app.
No, not anymore. We're looking at a blueprint for a completely self-sustaining financial ecosystem.
Exactly. And it's a blueprint that, it challenges almost every assumption we have about legacy banking.
Oh, absolutely. Block is outlining this highly coordinated strategy to capture both sides of the modern economy. You've got the consumer who's spending the money, and then the merchant who is receiving it.
Right out of the gate in this presentation, they set the stage with four core financial objectives. These are essentially like their North Star. First, they want to drive consistent, profitable growth. Second, maximize gross profit across their entire portfolio. And third, and this is a really crucial one, they are rigidly adhering to the Rule of 40.
Yeah, the rule of 40. For those who might not, spend their days swimming in tech valuations, this is a major benchmark.
Right. Can you break that down real quick?
Sure. So it dictates that a software company's revenue growth rate plus its profit margin should add up to at least 40%.
Got it.
It is basically the ultimate test of whether a company is balancing aggressive expansion with actual real financial discipline.
Okay, and their fourth objective is creating value for shareholders through disciplined capital return. And I want to say, whether you're an investor looking for your next portfolio move, or an entrepreneur trying to understand how a massive platform scales, or just, someone trying to manage your own money in this digital world, this matters to you.
It really does.
Yeah.
Understanding how these financial giants operate behind the scenes, it gives you a roadmap to where the entire economy is heading.
Okay, let's unpack this. Because to understand where they are going, we have to solve that massive, glaring contradiction in their Q1 numbers.
Ah, yes. The $309 million top-line paradox.
It's staggering. Let's look at the actual Q1 2026 highlights. The growth is undeniably massive. Gross profit grew 27% year over year, hitting $2.9 billion.
Which is a huge number.
Huge. Their adjusted diluted earnings per share, so the profit allocated to each share of stock, that skyrocketed by 52%. And their adjusted EBITDA hit $1.01 billion, maintaining this really highly stable 35% margin. So the engine just seems to be producing massive amounts of cash.
It is. But then, we look at the net income line. And we see the company swung from a $190 million profit a year ago to a $309 million net loss this quarter.
Which seems entirely counterintuitive.
Right. To solve this mystery, we really have to look at the mechanics of corporate accounting. We need to separate the paper reality from the operational reality.
Okay, let's talk about that operational reality. Because whenever I read earnings reports, I see companies throwing around the acronym EBITDA earnings before interest, taxes, depreciation, and amortization. And I don't know, it can sometimes feel like a corporate buzzword used to hide bad news.
Yeah, that happens a lot in earnings calls.
But here, they're leaning heavily on adjusted EBITDA. What is that actually measuring in Block's case?
Well, think of EBITDA as the raw horsepower of the business engine before the tax lawyers and the accountants get their hands on the ledger. It measures the actual cash the business generated from its core operations.
Like processing payments and facilitating loans.
Exactly. Selling software, all of that.
Yeah.
But you mentioned the word adjusted, and that is where the $309 million loss comes in.
Right, because the footnotes in the presentation, they explain that this net loss is driven by very specific one-time factors, primarily Bitcoin remeasurement losses and restructuring charges.
Let's take the Bitcoin remeasurement first.
Yeah.
Block holds a massive amount of Bitcoin on its balance sheet.
They always have, yeah.
Right. And under corporate accounting rules, if the market price of Bitcoin drops during the quarter, Block is required to record that drop in value as a loss on their income statement.
Even if they didn't sell it.
Exactly. They haven't actually sold the Bitcoin. They haven't lost any physical cash. It is simply a paper loss mandated by accounting standards.
That makes me think of like a massive cargo ship, right? The ship's engine is running 25% more efficiently than last year. It's pushing across the ocean faster than ever.
I like that analogy.
But the ledger shows a massive loss because the market price of the crates sitting in the cargo hold temporarily went down. And, well, they also spent a bunch of money up front to automate the engine room so they could cut crew costs tomorrow, which would be those restructuring charges.
That's a great way to look at it.
The ship itself isn't sinking. In fact, the actual mechanics of the ship are stronger than ever.
Yeah, and what's fascinating here is how clearly that strength shows up when you strip away those cargo hold fluctuations. Block's adjusted operating income margin, which tracks the pure efficiency of their daily business, it actually hit 25% this quarter.
Wow.
Yeah, that is up 5 full percentage points from a year ago. That kind of operational leverage, it doesn't just spontaneously appear. It requires a machine perfectly designed to capture and hold on to cash.
And that machine is built on two very distinct ecosystems operating under the Block umbrella. So let's pivot to the first one on the consumer side, Cash App.
Consumer engine, yeah.
The gross profit numbers here are fascinating. Cash App grew 38% year over year to $1.9 billion. But the metric that really matters is what they call primary banking actives.
Right.
These are users who treat Cash App as their main bank account. And that group grew 18% to 9.7 million users by March 2026.
See, that is the pivotal metric. I mean, an active user might just use the app once a month to, I don't know, pay a friend for a concert ticket.
Exactly, splitting a dinner tab.
Right. But a primary banking active user has routed their employer's direct deposit straight into the app. Block is capturing the money the second it is created.
Because Cash App's ambition has totally shifted from just peer-to-peer payments. They stated explicitly in the presentation, they want to be the financial operating system for the modern earner.
Which is a bold claim.
It is, and they are building this on 4 pillars: network, commerce, banking, and Bitcoin. But looking at the breakdown of their revenue growth, something stands out to me as a massive drag.
You're looking at the Bitcoin revenue, aren't you?
Yes. The financial solutions segment exploded by 66%, and commerce enablement grew 25%. But the Bitcoin ecosystem actually declined by 31% year over year. Cash App built a huge part of its early identity on making crypto accessible. So are they just outgrowing their crypto roots? Are they abandoning it?
Well, it's less about abandonment and more about maturation, really. The mix of their revenue is shifting because they're succeeding so wildly at deepening their hooks into traditional banking services.
So the banking side is just overshadowing it.
Exactly. Think about it. Bitcoin is highly volatile and transactional, but banking, savings, and lending, those are sticky. They're habitual.
And the presentation actually brings in qualitative data to prove how sticky this is becoming. They highlight a user tweeting about how utilizing the Cash App savings account is actively getting them closer to buying a car.
Yeah, I saw that.
Another user called the app a blessing for managing their savings, stocks, and daily payments all in one place. And it strikes me how incredibly difficult it is for a brand to engineer that level of trust. We're talking about people's life savings here.
Their car funds, exactly.
Right. Traditional banks spend billions building marble lobbies and slapping established in 1904 on their doors just to signal safety. And Cash App is doing it with a neon green logo on a smartphone.
Trust in the digital age isn't built with marble anymore. It is built with frictionless utility. If the app never crashes, if the direct deposit clears 2 days early, and if buying a fractional share of stock takes 3 taps, the consumer feels a sense of control.
And that control translates directly into trust.
Precisely. But that 66% growth in financial solutions you mentioned earlier, there is a very specific, highly aggressive engine driving that number.
Okay, here's where it gets really interesting, because that engine is consumer lending. Their origination volume for consumer loans grew an astonishing 82% year over year in Q1.
It's massive.
They originated $17.6 billion in a single quarter. And the star player driving this is a product called Cash App Borrow, which is scaling at a vertical trajectory compared to their older products like Afterpay Post Purchase.
It is a massive acceleration in capital deployment, no doubt about it.
But I have to push back on this because accelerating loan origination by 82% in 12 months sounds terrifying. Handing out billions in short-term loans through a smartphone app. How is this not just a subprime crisis waiting to happen?
It's a fair question.
I mean, are they just giving cash to anyone? How do they actually know the people they are lending to have the capacity to pivot back?
This raises an important question, and it goes right to the heart of how Block is attempting to rewire the financial system entirely. If they're using traditional FICO scores to underwrite these loans, a $17 billion origination volume would indeed be terrifying.
Because FICO scores are so backward-looking.
Right, FICO scores are essentially a snapshot of a consumer's past mistakes.
Mhm.
But Block isn't relying on that. They're using proprietary behavioral underwriting.
So they are looking at the actual real-time movie of a user's cash flow.
Exactly. The presentation provides a pretty deep cohort analysis to prove how they manage this risk. They break down their loan origination by user tenure, meaning how long the person has been acting in the Cash App ecosystem.
Right. They have 3 buckets: 0 to 6 months, 7 to 12 months, and 13 plus months.
And if you look at the data, the newest users, the 0 to 6 month bucket, they have the highest gross loss rate at 3.16%.
Which makes sense. But
Yeah.
then the 13 plus month cohort, the users who have been routing their paychecks and buying their coffee through the app for over a year, has a significantly lower loss rate of just 2.67%.
Exactly. By the time a user actually qualifies for meaningful credit through Cash App Borrow, Block doesn't need to guess if they are creditworthy.
They already know.
They have a year of microscopic data on exactly how much money flows into the account every Friday and exactly how much flows out by Sunday. It is a closed ecosystem credit score,
That's fascinating.
and it allows them to aggressively expand lending volume while tightly controlling the default risk. They are basically using tenure to filter risk.
It is brilliant because they hold the consumer's primary deposit. I mean, if you owe Cash App money and your paycheck is direct deposited into Cash App, the repayment friction is basically zero.
Right, they're first in line to get paid.
But capturing the consumer's paycheck and loaning them money only solves the demand side of the economy. To truly own the financial loop, they need to control the supply side. They need to be the operating system for the places where those consumers actually spend their money.
Which brings us to the other half of the Block ecosystem, Square, the invisible infrastructure on the merchant side.
Let's get into Square because their metrics are showing incredible resilience. Their gross payment volume, or GPV, grew 13% overall. But the geographic expansion is the real story here for me.
Oh, the international numbers are great.
Yeah, U.S. volume grew a solid 8.2%, but their international volume surged by 35%. Square's total gross profit hit $982 million.
And Block outlines 3 pillars for Square's strategy to keep this going: commerce, automation, and networks. Because they are moving far beyond just being a white plastic card reader on a coffee shop countertop.
Right.
They are essentially attempting to automate the entire back office of a small business, using Square AI tools to put operations on autopilot.
I think about Square like the invisible stage crew of a massive theater production. You know, when you go to a play, you only see the actors on stage. When you go to a coffee shop, you only see the barista making the latte.
That's a good way to put it.
But Square is the crew in the shadows, pulling the ropes, managing the stage lights, doing all the heavy lifting so the actors can just act. But they aren't just a manual stage crew anymore. They're using AI tools to essentially build a stage manager that automatically knows when to drop the lights, order more inventory, and run payroll without the actors ever having to ask.
And that automation is what creates deep merchant loyalty. The presentation brings in direct quotes from real business owners to highlight this. You have Chris Koske from GolfTech saying Square lets their coaches focus purely on fixing swings.
Right, rather than wrestling with 5 different disjointed software systems for scheduling and payments.
Exactly. And then Jeremy Lyman from Birch Coffee praises the ability to run so much of the business through just one ecosystem. Once a business integrates its payroll, its inventory tracking, its shift scheduling, and its payment processing into one platform, the switching costs become astronomically high.
You don't just rip all that out to save 0.5% on transaction fees with some competitor.
You really don't. Which explains the monetization stability we see in their charts. Investors always worry about a race to the bottom on pricing in the payment space. But Square's commerce enablement rate, which is the fee they take for processing transactions, it is holding incredibly steady at around 1.22%.
And their financial solutions rate is stable around 0.45%, right?
Yep. This is a massive green flag. They are acquiring merchants internationally at a 35% clip, and they aren't having to slash their prices to win them over. They're monetizing them with incredible consistency.
There is a specific feature rollout mentioned in the presentation that caught my eye regarding how they scale these networks. They talk about a service called Neighborhoods, which connects local sellers. The chart shows a sharp vertical upward trend in seller location enablement starting right in Q1.
Yeah, I know the chart you're talking about.
And the catalyst for that spike was simply changing the feature to auto-enrollment.
Auto-enrollment is a massive lever. It proves that Block can introduce a new network feature, completely bypass the friction of asking millions of busy merchants to manually opt in, and immediately turn on a localized network effect overnight.
It bridges the gap between individual, isolated merchants and a cohesive local ecosystem.
Exactly.
So if we step back and look at the machinery we'd unpack today, we have the Cash App consumer engine aggressively hooking users into primary banking and utilizing proprietary behavioral data to fund $17 billion in loans.
Right.
And on the other side, we have the Square merchant engine expanding internationally by 35% and automating the back office so deeply that merchants literally never leave. So, with both engines firing, what does this actually mean for the rest of 2026?
Well, it means the market has to prepare for hyper-efficient scaling. Block actually raised its full-year 2026 guidance based on this momentum. They are projecting a 19% growth in gross profit for the year and a massive 62% growth in adjusted diluted EPS.
62%.
Yeah, looking just at the upcoming second quarter alone, they project a 39% jump in EPS and 20% gross profit growth.
That is aggressive forecasting.
If we connect this to the bigger picture, this brings us right back to the very first slide of their presentation, the Rule of 40. In the 2010s, tech companies burned through billions of dollars of venture capital just to acquire users, with absolutely no regard for profitability.
Growth at all costs.
Exactly. But Block has matured past that. They are expanding their margins, projecting up to a 27% operating margin for the full year, while simultaneously accelerating product adoption across both of their platforms. They are proving they can grow and generate cash at the exact same time.
So, what does this all mean? We've cut through the accounting noise of a $309 million paper loss to find a highly profitable cash engine. We've seen how they capture consumer deposits, mitigate lending risk without traditional credit scores, and lock in merchants with AI automation.
It means Block isn't just a participant in the financial sector anymore. They are actively building a parallel infrastructure.
And I want to leave you, the listener, with a final thought to mull over based on everything we've explored today. Block currently has 59 million active consumers sitting on Cash App and a rapidly expanding global network of Square merchants. What happens when Block successfully closes the loop entirely?
Disintermediation on a massive scale.
Imagine a near future, and honestly, based on the velocity of this Q1 data, it really isn't science fiction, where a consumer has their paycheck deposited directly into Cash App. A few days later, they use Cash App Borrow to instantly get a short-term loan for, say, a new laptop.
Yep.
They walk into a local electronics store and they spend that borrowed money directly at a Square merchant terminal. The money moves from the employer to the consumer to the local business, and the entire life cycle of that cash is facilitated, monitored, and monetized by Block.
It never once touches a traditional legacy bank.
Exactly. If Block successfully becomes its own self-contained closed-loop economy, how will legacy banks survive the next decade when the modern earner no longer needs them for a single transaction? Thank you for joining us on this deep dive. Keep asking questions, keep looking beyond the surface numbers, and we'll see you next time.